When it's about trading, you hear about various strategies whose traders promise, for example, 90% win rate, large profits already in the first month, etc. And in fact, when choosing a popular indicator, the chart history often shows that it often gave true signals. However, the chart history only shows closed candles and does not reproduce the entire candle formation process in a given time window. Additionally, many of the various factors that are not present in live trading like greed, fear, and other emotions are not present with pure historical data, which we have no influence on. In practice, it is quite literally impossible to make long-term profits by using indicators as a tool to predict future price movements. However, there is another way that, at least for me, has been working for a long time. Everyone knows what indicators look like, but not everyone knows how they work and when they work well. SMA is, for example, the arithmetic average of closing price of candles for a period. MACD is also based on moving averages, Bollinger Bands too, but RSI is based on relative price changes. The conclusion is that it is easy to select indicators based on similar values, giving false confirmations of the signals. So, to avoid falling into such a simple trap, check out my video where I talk more about it. Indicators do not always work with the same effectiveness. They are usually most effective during strong trends, and during consolidation, they are more likely to give false signals. And that is why you can't mindlessly follow the arrows and make money.
Oh my god, bro. Oh, hell no, man. What the fuck, man?
There are a lot of indicators of all types, appearance, operation, etc. They are divided into two main types, those based on the trend, SMA, EMA, MACD, etc., and oscillators, RSI and RSI stock. As I explained earlier, it is easy to choose indicators of the same type that give similar signals. For this reason, two types are used at once, for example, SMA and RSI. Then the signals of the two indicators are not based on the same data, so if, for example, SMA and RSI show a buy signal, you can be more certain about the current state of the price. Many traders use indicators as a tool to predict future price movement, and this is where they make a big mistake. Indicators show the result of past data calculation, and consequently they can only be used to suggest the past and current market situation, not the future market situation. To explain, I will give an example. A person who uses indicators incorrectly when he sees a signal to buy thinks, oh, since my indicator showed me a buy signal, the price will probably go up. A person who uses indicators correctly will think, since my indicator showed me a buy signal, it is a good time to look for a good moment to enter a position if a price goes up. See the difference? The difference in the thinking of these two people is that the first one speculates that the price will probably go up and as a result buys, and the second one assumes that if the price starts going up, it may be a good opportunity to buy. Now it's time for the press. First, I will show you a trade I recently made on Ethereum. There have been declines in recent days, so I waited till the price rose to the resistance. I marked support and resistance zones. I used the area between the two weighted averages as the zone in which I will take a position. Then I set the stop loss above the weighted averages and the take profit at the same distance as the stop loss. And this way I earned 4.5%. So now I want to show you live how I do it. I'll draw a token and a month. There's a nice upward trend, so naturally I will try to look for long. Alright, now I will set the support and resistance and wait till the price reaches support line. Okay, I see a large bearish candle, so if the price goes lower I will set another support zone. This green candle shows me that it is worth going long. Now, if the price goes down around the red arrow, I will consider whether to exit the position, as you see. Okay, the price has gone lower, so I will wait until it increases a little more so that I can exit the position with a smaller loss. I think this is a good place to go, and I'm down 2.8%. The price broke through the resistance again and went down to resist of this zone, so I think this is a good place to buy. The price clearly has a problem breaking out of the two moving averages, so I prefer to safely exit with a small loss. And now I'm down 6.8%. Additionally, the situation looks like the price will drop, so I'm selling it. Yeah, like I said, the price dropped quickly, so I'm making up for the loss just as quickly. For now, I'm slight profit of 0.2%. And accidentally I skipped a few days, but now it happens, so I'll try to find another good place to open a position. Due to the fact that the price is close to support and stopped at weighted averages, I'm taking a long position. If the price drops below support, I will probably sell, and I will set the take profit in approximately the same position as the stop loss. And I gain 6.5% and at the end 6.7%. I hope this video was helpful to you and maybe it made you look at indicators from a different perspective. Everyone develops experience and their own trading style over time. What works for me may not work for you. You may prefer other indicators, use them at different times, or not use them at all and rely on support and resistance. By the way, Bofu Trade will have some changes very soon, some more content, a bit different than usual, and our new channel Bofu Shorts, of course. Remember this moment, what I'm saying right now, and what I'm saying right now is Bofu from now. Well, maybe not from now, but from like a few weeks from now, we're gonna start to blow up a bit. Mark my words.